Good evening, everybody. Thank you for coming to the symposium this evening. I wanted to thank, first and foremost, University of Baltimore and the Graduate Tax Program for hosting this event tonight. I think it's going to be a very lively and entertaining and educational discussion, so I'm looking forward to that. I want to thank the Maryland State Bar Association for providing a videographer so that we can record this event. I'd like to thank the panelists for giving up their time and preparing for it. And I think that's about it. For those of you in the tax section, we have tax section networking night coming up in November. Watch your emails for that. I'd like to have a big crowd. And with that, I'll turn it back over to Vadim, who's going to introduce the panelists, and we'll go from there.
So we have three panelists today, Liz Steve, David Rosen, and Mark Vulcan. Each one has very extensive experience in legal matters, tax, and government service. If everyone could give a little brief information about yourself, starting with Liz.
Sure, my name is Elizabeth Steve, and I'm an associate at Venable in the Tax and Wealth Planning Group.
Hi, David Rosen. I'm a partner and chair of the tax group at Rosen, Saperstein, and Friedlander.
Hi, I'm Mark Vulcan. I manage the business tax credits for the Maryland Department of Commerce. We generally handle all the business tax credits except for the old historic rehabilitation tax credit, now called the Sustainable Communities Tax Credit, which is handled by the Department of Planning and the Historical Trust. We also do not handle the film credit. That's administered by our section of the Tourism, Film, and the Arts. So otherwise, there are 17 programs that we're involved with. So thank you for the invitation and look forward to our discussion.
Okay. David will first discuss, go over the Opportunity Zone program and just discuss structuring and different tax compliance issues.
Should I do it from here or standing?
You can do it whatever you prefer.
Okay, so good evening. Oh, good, I get two. We're gonna talk tonight, give you a little overview of the Opportunity Zone program, and then give you and describe how businesses, as well as real estate, can benefit from the Opportunity Zone program. So I usually start by saying, how did we get here? How did this happen? So, under the 2017 Tax Act, they passed Section 1400Z-1 and 2 to enact the Qualified Opportunity Zone program. The original bill actually was originally proposed earlier in 2017. It was not first introduced under the 2017 Tax Act. And it was based on a white paper prepared by the Economic Innovation Group in 2015, in which a think tank was trying to articulate a way to create a tax incentive program that would attract capital into low-income communities. And as you can imagine, this was something very attractive to actually both sides of the aisle. So interestingly enough, the bills that were proposed in 2017, the House version had 45 Republican sponsors and 36 Democrat sponsors, and the Senate version had seven Republicans and 7 Democrat sponsors. So this is truly bipartisan. And what they did was they created a program in which we have 3 key buckets of tax incentives. The first one is that you get to the extent that you reinvest capital gains into a qualified opportunity fund, you get to defer that capital gain until the earlier of the date that you sell or exchange your investment, or December 31, 2026. So that means, today we're looking at a 7-year deferral, and that's, it's quite valuable. So as long as you reinvest capital gains, you don't have to pay the tax for many years. In addition, after you hold your investment for 5 years, you increase your basis by 10%, which has the effect of eliminating 10% of the original deferred gain. After you hold your investment for 7 years, so long as that occurs prior to the date that we recognize those gains, which means you have to get it in by December 31 of this year, you can achieve a 7-year holding period and increase your basis by another 5% and eliminate another 5% of your original capital gain. So if you meet both holding period requirements, you can reduce your original capital gain from $100 to $85. But what they did that was interesting was they aligned both the short-term incentives to invest and try to defer capital gain with the long-term desire to improve our low-income communities by providing that if you sold or exchanged your investment after 10 years, all of your gains would be tax-free. And so this is very compelling. You invest $100 of gains. I would owe $30 on as a Maryland resident, really $32 in most counties. I don't have to pay that now. I can pay that in 7 years. I wait till 2026, I pay that tax. And if I hold it for 10 years, till 2029, and I sell, I get to get all of my gains tax-free. So what does this mean for an investor? So an investor who does this, if I invest in a qualified opportunity fund, it has the effect of increasing my return by about 50% on average. Most of the ones we have modeled out, we are coming out to about a 45 to 55% increased return. And it is a function of the return because the tax-free appreciation is in fact on the growth. So this doesn't make a bad investment good, but it makes a good investment really good. So you can imagine that you invest in a fund or in a particular business and you get a 12% return, and this converts effectively to an 18% return. And an 18% return is very compelling. So basically, to summarize that, is they've created a relatively easy to understand program, much easier to understand generally than most tax credit programs, because credit programs people have a hard time understanding how they use the credits. They have a hard time understanding sometimes how it monetizes and how their original cash investment turns to immediate return. This is much more understandable. When we first looked at the Opportunity Zone program, it was very easy to understand how this would work in the context of real estate, because under the program, we have to invest in a qualified opportunity fund. A qualified opportunity fund doesn't have to be a fund in the traditional sense. It's merely a partnership or corporation that holds 90% or more of its assets consisting of qualified Opportunity Zone property. Qualified Opportunity Zone property is either Qualified Opportunity Zone partnership interest, Qualified Opportunity Zone stock, or Qualified Opportunity Zone business property. So I'll use the last definition first because it kind of drives what it takes to get into the program. This is property acquired after December 31, 2017. This is property that's located inside of a Qualified Opportunity Zone, and it's property that either the original use commences with the taxpayer or is substantially improved by the taxpayer. So you can see how real estate, this makes perfect sense. I acquire real estate in an Opportunity Zone and I develop that real estate. And so it's easy to see how I get into the zone. And if I've met those requirements, I get those tax benefits we described. I do want to reiterate the threshold in order to qualify for an investment is to reinvest capital gains. So if you don't have capital gains, you're not going to qualify for the tax benefits and this tax-free appreciation. There are some structuring considerations around that, how we can ultimately use debt that later converts to equity. Maybe Liz will be able to touch on that in her when she goes through some of the nuances of the fund structures. But what does this mean for a business owner? So when we think about a business, we don't always, unlike real estate, a business reaches out into and does business all over the place. So it's a little more challenging to understand how we can have a business that is inside of a qualified opportunity zone because we're bound by a geographic location. Now, what they've done is they've provided some latitude. They provided 4 different tests in order to allow a business to qualify for qualified opportunity zone benefits. And so when we think about what this means for our communities, and is that we're trying to accomplish on the policy side is to have a business relocate into an opportunity zone or locate into an opportunity zone, hire employees, create jobs, create value, and then the owners of that business will benefit from that value creation. The challenge here with businesses is, unlike real estate, is that the big benefit under the opportunity zone is not the original tax-free deferral. It's the 10-year tax-free appreciation. But businesses, you don't always have the same flexibility on when you're going to sell. So we have to be thoughtful about what businesses make sense. And it's businesses that can drive value, and we view that we have a long-term holding period. It's not that the original tax benefit from the deferral is immaterial, but it's only worth about 25% of the total tax benefits if we view it, again, in terms of investment returns. So when we're dealing with, so I'm working now with a couple dozen businesses that are looking at either locating or relocating in an opportunity zone. And we have a few, and so the first thing that we're thinking about is if we're going to start open a business in an opportunity zone, we need to keep it qualified. So we need to meet the tests. The tests are generally 50% of the active conduct of that business must occur inside of an opportunity zone. We measure that through either the hours of the employees in the zone, the compensation of employees in the zone, the property located in a zone that has to be more than 50%, and then there's a facts and circumstances test, which hopefully we don't have to rely on too much because we tend to not have that much, yes?
Is that an or for those?
Or any of the 4 tests. They were very liberal in the way they wrote the proposed regulations because they really want this to work. They really want people to invest in businesses. I kind of view the Opportunity Zone program as being really a 3 stages. The first stage is heavy on real estate because it's infrastructure development. Because there's a lot of money now searching, looking to that is being raised for these funds, and most of them are on the real estate side. And the first phase is to build out real estate developments inside of low-income communities. And we have some, in Greater Baltimore, the whole, the whole CBD for the most part is in opportunity zone. Port Covington is almost all of it is an opportunity zone. Areas throughout many areas throughout throughout Baltimore City are located in a zone, and throughout the state of Maryland. And so long as we can kind of build the right facilities, we hope that we can get the businesses to come into the zones. Yes.
Is there any, do the investor entities have to be anything specific, or just individuals?
It needs to be a partnership or a corporation. So if it's so you can have a 2-person partnership or you and a trust or an S corp that you own, et cetera. You can form a partnership and qualify. It does not have to be a fund. There are no dollar limits and there are no dollar minimums or maximums. You can invest $1,000 into a business. I think your transactional costs would be, in professional fees, would be a lot higher than that $1,000. But you can also invest, millions of dollars, and and your tax-free gain is unlimited, which is something else that's different than the credit programs, because the credit programs are generally capped and you allocate dollars. There is no limit. If you create the next Google or Apple and you put it into an opportunity zone, so long as you can remain inside the zone, you can get the tax-free appreciation as long as you sell it after 10 years. You have until December 31, 2047. So we have almost 30 years to dispose of a business, of our interest in a qualified opportunity fund, and obtain the benefits. But when we think about a business, many businesses have locations all over. Many businesses have different types of business, some of which would work properly in a qualified opportunity zone and some don't. So what is it, and from an investor perspective and a business owner who is also an investor in their own business, an equity owner, they are interested in extracting the maximum tax benefits. So what we're trying to do when we think about these businesses, how do we shift value into an opportunity zone? So let's think of a tech company, okay? A company that develops computer software and and maybe has a SaaS model or something. How do we shift value into the zone? Well, what is the value of that business? It's in our IP. It's in our R&D. It's in our management. In some cases, it will be in our sales. So we're trying to think about how do we put a corporate headquarters inside an opportunity zone and have it in its own entity? How do we shift the value drivers of our business into the zone? You want to have your research team inside the opportunity zone because that's the value driver. Because if you have a business that might have a qualified opportunity zone business and might have a non-qualified opportunity zone business, what we're focused on is trying to make sure that we create as much value inside the zone as possible. So when I'm talking to business owners about how do we make this shift, we run into a number of challenges. Because what if it's an existing business? You can't just take an existing business and all of a sudden make yourself a qualified opportunity zone business owned by a qualified opportunity fund. Remember, we noted the assets have to be acquired after December 31, 2017. So what if it's an older business? Interestingly enough, the regulations permit a lease of assets to a related party. So you can actually move a business through, frankly, a complicated leasing transaction. I explained to clients how we can do this, how we can shift an entire business into a zone by merely leasing all of its assets to a zone entity. As long as it wasn't previously in a zone, there's some challenges there. But here, the thing that I also have to explain to clients when we say we're going to lease a business into a zone, I'm pretty sure there's no one in this room who's ever taken an entire business that's not real estate and just leased it to a related party and said, we're going to operate under a different entity. It's not a transaction that actually is in the market. So for an existing business, this creates a level of complexity that we have to try to overcome. We can meet the criteria under the program. Because we know that related party leasing is permitted. It's just not really a commercial transaction that we've come to accept in the marketplace. So an alternative might be instead for such business to just open new businesses into an opportunity zone. And then that gets back to our desire, the earlier point of how do we shift value from the existing entity into the new entity? And how do we deal with the fact that many businesses, if they're on a good ramp and they're doing well, we sell them earlier than 10 years. So we're not going to extract that tax-free appreciation potentially. And so you have to realize that, you may not get there on the tax, you may not get all the tax benefits if the business itself is performing and the right time to sell is earlier than 10 years. Unlike real estate, where you're very comfortable that the value is not going to change that much, especially if you have a long-term lease in place, from year 8 to year 10, you really can't say the same for many businesses. So, so we have to be a little more flexible on the business side and think about whether we should hedge our bets. We have I have at least one client who's going to form their qualified opportunity zone business as a C corp, so that we can meet the qualifications as a qualified small business, because the disposition of qualified small business stock under Section 1202, you get the first 10 million of gain, or 10 times your basis, whichever is greater, is tax-free. So, we're looking at kind of a lot of different, we're trying to figure out how to kind of, to some extent, put the square peg in the round hole, because while they designed this really well for real estate, for business, it really wasn't as, there is a little more hair on it. You have to go through the analysis to meet the different tests. But if you win, if you can make this work, think about what you can get. Imagine that you start a business and you turn your original investment of $1 million into a $100 million business. And you get to sell in 10 years, one day. That is, if you structure it right and you're able to sell your investment in the QF, it's 100% tax-free. Fortunately, but as most people here who deal with transactional work know, most businesses are not actually sold in stock sales and equity sales. They're sold in a variation of an asset sale. It may be an equity sale for state law purposes, but an asset sale for tax purposes. And so what they did under proposed regulations was they gave an election in which a qualified opportunity fund can exclude the gain from the disposition of qualifying assets that generate capital gains. And so that works. Another thing that works pretty well in real estate, what's interesting on real estate is because the mechanism to extract tax-free gains is a basis adjustment to fair market value, the net effect on the real estate side is not only to extract tax-free gains, but over the course of life, you will have losses from primarily from depreciation. And then because you're stepping up to fair market value, you will avoid depreciation recapture forever. So when I gave the example, when I gave the numbers before and the 50% return, that's inclusive of those amounts. But when we think on an operating business, if you sold all the assets, you don't get the same level of tax benefits if you end up in an asset sale. And the reason is because the election to exclude gain only applies to the disposition of qualifying property that generates capital gains. And if you're involved in the sale of businesses on the transactional side, you typically have substantial ordinary income assets, non-capital assets, cash basis accounts receivables, depreciated fixed assets, inventory, but although it's usually at book value. So you're not gonna, so the business context again requires a lot of structuring, I think, and I don't know how much time. 5 more minutes? Yeah. All right, I'm good on time. I was trying to rush through. So it is really critical that you think through the structuring of these in advance, because you have to be prepared for the year 10 disposition. I didn't touch on some of the investor side, like kind of concerns on what types of gains qualify and when it qualifies. that really wasn't the initial focus here, but I think it's thank you. Appreciate it. So when we are trying to, but I've been dealing with this with at least one business fund where we're trying to say, what is the business case for investors to invest in our qualified opportunity fund? What is the, how can we be comfortable that we're going to extract the tax benefits that we're trying to obtain? And so that's where we have to kind of, that's where we have to go and focus on, what is the plan for this business? I mean, you have to recognize that businesses, unlike real estate, business assets move. Businesses evolve and they tend to open locations all over. They tend to have people who work all over. We have to, from day one, have a business plan that is consistent, that is consistent with meeting the operating requirements of an opportunity fund. This is not something that you can just, I guess, punt on and see, will it work? If you're really going to make the commitment to enter into to actually go through the steps of creating a opportunity fund. So I think that if you have clients who are thinking about, what's I guess the right way to think about what does it mean to have a qualified opportunity fund business that's operating as a operating business. And I've used the term with some clients to say, we have the predictable benefits. I will get that deferral on day one. But to get the 10-year appreciation, that's kind of like a lottery ticket. Because, it's just not, it's the, 10-year hold for a quickly accelerating business just isn't necessarily that predictable. Excuse me. But at the same time, notwithstanding that you don't have the same predictability, your upside is so much greater because your potential returns in operating business are effectively, in many cases, are just much, much potentially higher. Not necessarily, at least for the initial founders of a business. And so when a client is thinking about, should I go through the effort of doing this? So I kind of break out the two pieces into the predictable and the unpredictable. So the predictable is I put an investment in, I get an immediate deferral. Here's an interesting thing. What if you have a business that's riskier? What if you have a biotech business? Many biotechs fail. Or other technology businesses. What we realize is if you actually read what it says under the statute and under the regs, so I invest my capital gains, I defer those capital gains, so the earlier of the date I dispose of my investment, or December 31, 2026, and then what do I pick? And then I pick up his gain on December 31, 2026, which means I would pay it probably in April of 2027. The lesser of my remaining deferred gain or the fair market value of my investment. So if I asked you, what is the value of my investment if I invest in a biotech on December 31, 2026? What if I'm still pre-revenue and I haven't had a round of fundraising? What if the business hasn't yet hit its kind of inflection point and is still growing? Well, I would value my interests in the Qualified Opportunity Fund on December 31, 26, and what are they worth? Well, what if the business is worth $100 and I own 10% of it? Is my investment worth $10? Not necessarily. And it's not, because what I'm valuing is my investment. And when we value a closely held investment for income tax purposes, generally we discount the value for lack of control and lack of marketability. So this is a really compelling way to invest in a riskier business, and you can do something that's really interesting here. So imagine I invest $100. I invest in a business. I'll be done in 30 seconds. I invest in a business December 31, 2026. I have the ability to value that business after taking my discounts at $50. What gain do I pick up? If I had a 7-year hold, it's $35. Okay? I pick up gain of $35 on my $100 investment, because I would value it at 50 and I still get my 15% basis adjustment. That comes after in the calculation. So I pick up gain on 35. So even though, and what's really interesting here is I don't have to dispose of I can still hold my equity investment, and I've eliminated $50 of gain, even though I'm still holding my investment. So for a riskier business, there is another way, basically, that it's sort of another tax incentive built into the program. There's a huge incentive to invest both in businesses.
So for 10 years?
So you could have eliminated part of more of your deferred gain and get your tax-free appreciation.
So are you, when that day you're talking about comes, you have to pay?
You have to pay the tax. You will pay it
When
midstream.
you get to 10 years, I thought you got to zero.
Your appreciation over and above. So you do pay tax on your original deferred gain, but not those invested dollars, the growth on that, you don't.
Thank you. No. Oh, go ahead.
So, with the, you touched on the qualified business assets, qualifying for one to do a transfer of assets as opposed to a sale of stock. How does that interplay with the holding rules? Equipment doesn't necessarily have a lifespan in excess of some of the holding periods, or, equipment gets replaced or upgraded.
Yeah, so the new equipment would qualify.
Okay.
That's fine, as long as it's acquired after and it's in the zone.
As long as it's within the.
50% or more if it has to be within the zone, if you use that test, yes. Sorry. It's,
Well, I have trouble keeping my mouth shut. So what I'm hearing is, as a litigator, as a tax litigator, what I'm hearing is, if you're going to do this, you better hire a lawyer that knows what the hell he's doing. Or else, hire an accountant who knows what the hell he's doing. Or else, you're going to have to come see me later. And because it's extremely complicated. And it seems to me that the ideas that you're coming up with, that the smart people, as I like to call you guys, the smart lawyers and accountants are finding loopholes. I don't want to call them loopholes. Finding ways to take advantage of this law.
maximizing the tax benefits.
That the IRS may or may not agree with later. And if you're going to do it, you better make sure that, we just did a program in Ocean City on the cannabis industry, and there was a business that did it right, and there was a business that did it wrong. And when they got to court, all the difference in the world. So, the only thing I would say to everybody out here is, it sounds like a wonderful thing. I think the intent was to have opportunity zones, to have investments put into these depressed areas, and it's wonderful. Make sure you do it right. Don't go to like Joe Smith, in the corner drugstore to set up your opportunity zone investment, or else you're going to wind up in a world of hurt at the end. That's all.
It was complicated enough that in order to figure out how to help manage these deals, I wrote a book on Opportunity Zones because I had so many of these deals, which, by the way, anyone here can download at, you can just go to ozcpas.com and download this. It'll be updated.
And you can find the link on the handouts.
All right, and Liz can take 5 minutes of our panel discussion because we just took 5 minutes of her time.
I apologize.
It's okay.
Not a
You're
problem.
allowed to interrupt her too.
So I thought it would be helpful to talk a little bit about the structure and the structure that we're kind of forced into as a result of the regulations, because I think David pointed out a lot of the issues that are going to come along in terms of the operational phase and the exit phase, and the structure plays into that. And at least from my perspective, right now where we are in the life cycle of the program, where we've been seeing most issues is on the structuring phase, setting up the fund and getting money into the fund and into the business. So David mentioned that you have your Opportunity Zone fund. It has to be a partnership or a corporation. And the big requirement here is that it has to invest has to hold 90% of its assets in qualified property. And that can be actual business property, like a piece of equipment in a zone, but more often than not, it's going to be Opportunity Zone partnership interest or stock in a lower tier entity. And the reason why we have this two-tier structure is kind of a function of the regulations we've received so far. So investors have 180 days from when they sell their existing investments to roll over their gain into a fund. And then the fund has to satisfy this 90% asset test at various testing dates throughout the year, generally 6 months, so end of June and end of December, and certify to the fact that it has 90% of its assets invested in this certain type of property. To the extent that it does not satisfy this test, it pays a penalty. So what happens if it has too much cash? You pay a penalty. The way that people have gotten around this is that there's a working capital safe harbor that's available only for a qualified Opportunity Zone business. So there's no cash safe harbor that goes on at the fund level. If you have 15% of your assets in cash, you are not a qualified fund, you haven't satisfied the 90% asset test, and you're subject to the penalty. However, if you drop that money into a qualified Opportunity Zone business that satisfies the working capital safe harbor, it can hold on to the cash. So the working capital safe harbor basically says when you receive an investment, the business itself has to have a written plan in place designating how they're going to spend this money within 31 months, and the business has to substantially comply with this plan. So the problem that we've been facing thus far is that there are a lot of investors that are really interested in investing in Opportunity Zones, right? So they sell their stock or they sell their business and they've got all this cash and they want to put it into an Opportunity Zone fund, and then the fund has to get rid of this cash before it hits its testing date. So it wants to dump it into an Opportunity Zone business, which is great because now our business has money, but our business has to figure out a way to spend this money. So it has to have this plan in place, and most of the questions we've been getting so far are, what does the written plan have to be? How detailed does my written plan have to be? And what happens if I don't actually comply with my written plan? And unfortunately, those are all questions that we don't have answers to so far. So that can make things difficult for your operating business. So it has a bundle of cash. Now it's got to figure out what it's going to spend it on, and it's got to make sure that it substantially complies with that, or else you're at risk of terminating your qualified opportunity funds benefit for all of these opportunity to get all of these tax benefits. So there's a few issues here. First, what if you have a business that you want to invest in, but you haven't realized your gain yet, so you don't have anything to roll over? So you have to recognize gain, then you've got 180 days to roll it over. But you have a business that you think is great, it qualifies otherwise, it's got the gross income, all of those things, but you just haven't had a gain event yet, but you need to put money into it to keep it functional. So one thing people have floated has been this concept that David mentioned of making a loan that eventually converts into equity, because your investment from the fund level into the business has to be an equity, not a debt investment. Other problems we're running into, obviously, are people needing to dump their money before the end of the year. Either the investor who has sold their asset needs to put the money into the fund by the end of the year, or the fund needs to dump its money into a business by the end of the year. So getting the money into the business. If you have more than one business, how do you decide which business is getting your money? That actually has been a huge problem with people who know they want to do a bunch of different businesses in a zone, but maybe haven't figured out exactly what they're going to do yet, or they don't really know how much money each one is going to need. There isn't really a clean way to move money in between brother and sister businesses once you have them down at this lower tier. And then lastly, what happens when your business has been operating? You put the money in, it's got this 31 months of working capital safe harbor, it's got the cash, it has a runway, but later it decides, I need more money. Well, if you don't have any more Opportunity Zone investors, or they don't want to invest because, say, the period for the basis step up has closed, or we're after 2026, it may be difficult for you to attract investors. The new investors that you have will have goals that are different from your Opportunity Zone fund investors, so that potentially could be a problem down the line as well. Let me see.
Quick question. So what you're discussing is basically a tier structure into running the business. Is there any advantages that you can see that clients would have just running the business through the fund itself?
No. So if you run your business directly through the fund, you don't get the benefit of this working capital safe harbor. So let's say you have your fund and it's a partnership and you have a disregarded entity underneath and you're running your business through the disregarded entity, or the fund itself is running the business. You don't get this working capital safe harbor. So 90% of your assets have to be good property. By contrast, if you drop it into a partnership below, even if you own most of the partnership, you have this working capital benefit. So some of your money can be sitting there, more than 10% of it can be sitting there as long as it qualifies for the working capital safe harbor. So that's why we're kind of forced in this two-tier structure. A lot of people have asked, why do we not have three-tier structures? And part of the problem is because there are, in addition to these gross income tests and tangible property tests that David mentioned, there are a number of other tests that these businesses have to satisfy. One of those is that the business can't hold more than 5% in non-qualified financial property, which basically means cash, debt, stocks, securities. So we can't actually go to a third tier, because if you have a fund that has a partnership that's operating a business that has another partnership underneath of it, that partnership interest is going to be a piece of non-qualified financial property that will violate the 5% test. So we're stuck with a two-tier structure. Not good to go to a one tier, can't go to three tiers, and that's where we are.
I'm sorry, if you don't mind.
Yeah.
Would have, one issue that I've had come up numerous times is that we've had investors, family office investors and so forth, that have basically formed their own qualified opportunity fund with gains because they didn't have a place to put it, and then they go to funds and they find out, and you get to the rule that a qualified opportunity fund can't invest in other qualified opportunity funds.
Exactly, yeah. So it's really just limited to those two funds. You can't have a fund that just has its purpose to invest in other funds. You can't have a business that its purpose is just to invest in other businesses. You generally will have one fund and a business, or perhaps a number of businesses underneath that are each siloed into their own partnership.
Have you been creating structures so at the fund level so that you have the ability for those types of people who've created their own qualified opportunity fund to invest directly in the QOZB level?
Yeah, because the other thing that's interesting about this is that the fund has to be a partnership or a corporation, and I probably have said partnership most of the time because that's how most of these I'm seeing, although I like the 1202 option if you have a corporation underneath. The fund has to be a partnership. The operating business also has to be a partnership, so you're going to always have a second owner at that bottom level. Generally, if it's kind of what I would think of as like a closed circuit investment, you would have the managing partner, the developer, be your general partner in your partnership, that's the business, and then the limited partner would be your fund.
Are there any rules about hiring your aunt and uncle and your brother and sister and all that sort of thing?
There aren't rules about who you can hire, and there aren't rules about who can, kind of be your general partner or do something like that. There are rules if you have property or a business that's already in a zone and you want to transfer it into a new entity that is a good business. So this came up a lot when the program first was in place. They announced where the opportunity zones were located, and people thought, great, I already own property in an opportunity zone. I am going to qualify for all these benefits. And the problem is that you had to acquire the property by purchase after the date that these zones were announced, pretty much. So a lot of people have been saying, well, how do I get it to an entity where it can qualify? And there we have a very strict related party rule where you can't own more than 20% of the new entity and have it be qualified property. But in terms of actually doing the day-to-day operations, there's not the problem there.
Attribution rules apply to that?
Yes.
Related party.
Well, could you keep five people who own pre-existing property from clubbing together and as a workaround, or is that also the basically complex rules?
Presumably it could work, it would just be hard to find 5 people who want to put their assets into it.
And mix it up together, yeah. And I think that's actually an interesting question, though, because I think that's another place we've been seeing a lot of tension, is that it works because of the way the exit is structured and that it needs to be a sale of the fund for you to get the greatest amount of the benefit. We've been advising people that there should be a fund for each separate business. And so it's hard to kind of mix investments because then you have these businesses that are underneath and you're not selling fund interest anymore, you're selling partnership interest in those businesses. And as David pointed out, any kind of hot assets or ordinary income, you're going to pick up on the sale. So you're not getting this full exclusion. So it's hard with mixed assets because you have problems with the formation, finding those people, and then you're also going to have problems on exit if you can't. It's unlikely you could sell the portfolio of all five.
I've actually seen a lot of the real estate funds are looking at how they can convert to a REIT in the back end to create an exit vehicle that allows for liquidity for their investors and not be forced sellers after 10 years because you can just sell in the public markets.
You've been focusing in your analysis on the federal aspects, but we haven't mentioned anything about state nuances here, and that each state has their own peculiarities. And also, what you just sort of hinted at is there may be a choice as to which state you locate these activities in. And I was wondering if you could say something about the, I guess, SALT aspects, as it were.
So everything except for, I believe, 4 states have adopted the Opportunity Zone legislation. The ones that haven't was North Carolina, which completely decoupled from the federal treatment, and Hawaii, and I believe Arkansas or Alabama. I'm not sure.
California also,
And California
yeah.
is not, they haven't passed even the legislation.
So there's a whole spectrum on the state tax side, which is states like Maryland, or I guess actually Maryland's probably in the middle, because Maryland follows federal rules. So we are coupled with them. We get the benefits of Opportunity Zone deferral and hopefully potential exclusion. There are states like California and North Carolina where they are decoupled and you don't get any state benefits. And then there are I don't want to say a lot of states, but there are definitely some states that are taking this time to implement their own incentive programs to kind of pile on to the Opportunity Zone program. So there's really a full spectrum, and you'd have to look at where your investors are really, because they're the ones that are getting the benefit, right? It doesn't really matter where your operating business is to an extent, because your flow-through income is always going to be flow-through income, but when it's really on the deferral piece and on the sale piece, which is, affecting the investors.
I do want to highlight that if you had the perfect scenario where you sold a business and you were willing to invest a substantial amount into a qualified opportunity fund, and you sold it in a way that the taxation followed you, so you sold stock. Okay, it wouldn't work for an asset sale. And you were a Maryland resident or New York resident, and you invested in an opportunity fund and then moved to a non-tax state like Florida when you picked it up for 2026, you could eliminate the state tax. It wouldn't work if you had an asset sale where the state taxation would follow from the sale of those actual assets.
I wonder if they're going to put things in. I know California has that 1031 thing now. I wonder if they're going to. I don't know if you know this. If you do a 1031 in California and then you try to leave, they say, "Let us know when you eventually sell." So I wonder if they'll do that with opportunity zones as well. It'd be interesting. Yeah, I think
be permanent enough.
It's important to know what your state's rules are, but I don't think the fact that the benefit is not available for California purposes is a disincentive. You still get all the federal benefits, which is where most of the money.
Here, I'll tell you, this was interesting when we're thinking about tax dollars. So what happens if tax rates go up? Because I invest now, right now we have a 20% capital gains rate. What if the capital gains rate in 2026 is double that? It goes up to 40%. Am I better off or worse off? Everyone's thinking way worse off. I defer it at 20%, I pick it up at 40%. But if you sell 2 years later and we're still at the higher tax rates, the net impact of the qualified opportunity zone investment, you win. You're actually better off than had you not made it. So because you're going to get the benefit on the disposition after 10 years of not paying tax on those higher rates. So and since that's the biggest part of the benefit, you actually are, as long as the tax rate in 2026 is the same as the tax rate in the year of disposition, or is higher than where it is today, you are actually better off.
Don't worry about it.
That's a different discussion. There are definitely people who do have to worry if Bernie.
Question. I guess there's two people that I'm thinking of. There's people that are going to set these things up, whether it's a fund or whether it's their business or they're going to buy real estate. And then there's people that are going to invest in a fund. The people that are going to invest in a fund don't have to worry about structure. They don't have to worry about anything other than hoping that the people who they're investing in knew what the hell they were doing, right?
They have to, it is up to the investor to determine whether they have whether they meet the qualifications to reinvest capital gains within 180 days. And it's up to them to defer the tax on their return. And I think, do you want to talk about some of the nuances and the timing on those dates? On the 180 days?
Sure. I mean, I guess so. There's generally the 180 days. If you own a share of stock and you sell it, you have 180 days to roll over your gain. If you own an interest in a partnership and the partnership sells an asset or subsidiary entity, you actually, as the partner, if the partnership chooses not to roll over the gain, you have 180 days from the end of the partnership's taxable year. So in theory, if you have a partnership that sells something on January 1, 2018, and they don't roll over the gain into a fund, then you as the partner have until June 30th, 2019 to roll it over? 28th. Yeah, so there are some timing rules. I think what's interesting, what I was thinking when you asked your question is that there are obviously requirements at the investor level that you report this correctly and you're keeping track of everything and you're making sure you comply with the rollover requirement. There are requirements at the fund level. The fund has to file a form every year saying that it is a fund, has to elect to be a fund. It has to say that 90% of its assets are invested in this qualified property. But the business itself doesn't have any reporting or filing requirements other than its normal partnership tax return or corporate tax return. So I think that's where it gets interesting because that's where the real issues potentially could be if the business itself isn't satisfying this gross income test or the business has bad assets that could potentially disqualify the fund's assets. But the business at this point doesn't have any reporting obligation. Presumably that would be something, which is why you would want, even if you were an investor in the fund indirectly, you want to make sure your fund is managed by good people because you would want to make sure that the fund is putting those protections in place, like qualified opportunity zone business. We want to make sure you continue to qualify for substantially all of our holding period. You can't expand your business into areas that are disqualified. You can't start, having employees in a city where it's not a qualified opportunity zone. So there's some tension there.
I had an interesting one. I talked to a business fund. So I'm probably the only business fund that I've seen that actually has an active investment. And he started telling me about his next two investments, and I realized his next two investments, so this is the QOF's investments, they're convertible debt, which means they're bad assets. So typically in venture, they're very frequent that you invest in convertible debt. In a qualified opportunity fund, if they hold convertible debt, it's going to be a bad asset. And so a typical venture type business investment structure doesn't work. It's just so it changes the way we have to think about investing.
Yeah. And a lot of these, I know I've worked on a few PPMs and things like that for the funds, and they are just riddled with, we make no guarantees that anything will happen or that we will invest in anything that's qualified or that you will get any tax benefits. So it's a little nervous being an investor unless you know what you're getting into and what to look for.
Yeah, and you have to be sensitive at the fund level to your investors who are going to owe a tax bill in 2026. Are you going to try to help them have liquidity at that time? Originally, when it was first passed, we had a lot of funds who were like, yeah, I'm going to focus on trying to make sure we can do a refi in 2026. And then once they started drafting the PPM, like, let's not.
Someone also promised that.
Let's not go there. So it's just, it is a new program, and we're trying to build very rapidly, okay? Because all this has to happen in the next 6 years, and then we no longer have and then we don't, if it doesn't get extended, that's it. So all of these rules have to be in place rapidly, and then we have to figure out these structures and how it's going to actually work mechanically and operationally. And then by the time we figure all that out, it's like we can't do it anymore. So, my book will be literally worthless in 10 years. Fortunately, it's already written, so.
All right. Now, Mark will give some information about what programs and incentives and credits that Maryland can provide for for qualified opportunity zone businesses.
Thank you, Vadim. Thank you, other panel members, for your presentation. I'm learning. Again, we're focused on a very specialized part of taxation targeted specifically to the federal opportunity zones. I'm going to focus on some exact program focused on, again, opportunity zones. So my world is 17 programs within commerce. I'm only going to address a few of them that address opportunity zones, but our programs cover new jobs, equity investments, targeted industries, and also geographic programs. Vadim, are you going to advance? Okay, so Maryland was pretty quick to follow the federal opportunity zone legislation with Senate Bill 581 this last session, which created opportunity zone enhancement programs for several programs and also expanded the More Jobs for Marylanders tax credit program to opportunity zone businesses. So as a takeaway here and to start, the opportunity zone enhancements are just a little bit. The expansion of More Jobs for Marylanders for other businesses is significant because it's 5.75% refundable income tax credit on new jobs. Except for technology businesses, there is a considerable and a very valuable enhancement for startup cyber and startup biotech companies. So if you have a takeaway, the enhancements, again, generally speaking, for all the programs are not that great, except for the technology companies, cyber and bio. But it is good. It's just a little bit. It may make a Maryland choice for an investment a little bit better than a state that doesn't offer any other incentives. So we look to the qualifications, and the qualifications are, first, you have to meet the general program requirements, and the programs are the More Jobs for Marylanders, the Maryland Job Creation Tax Credit, the One Maryland Tax Credit, the Enterprise Zone Tax Credit, and the Biotechnology and the Cyber Investment Tax Credits. Understand that those programs each have their own rules with respect to job level, bars, how many new jobs, what the minimum pay requirements are. These are enhancements to those programs. So there are two levels in the Maryland legislation of where you're eligible for these enhancements. And the first is level 1, which mandates that you provide commerce with the date, the amount, the location, the investment, the total project investment, leverage, address, and census tract of the Opportunity Zone Business and Fund, NAICS code, and the impact report of the project. For, as I mentioned, the programs that are enhanced, the More Jobs for Marylanders, Job Creation Tax Credit, One Maryland Enterprise Zone, the business must in fact be one that is leveraged, or there's an opportunity zone fund investing in that business. So it is limiting. For the biotech and the cyber security investment tax credit, it requires again that the investment be made by the Opportunity Zone Fund. For a level 2 investment, which allows for greater benefits, you have to meet the level 1 requirements. In addition, there has to be accountability to the community, an advisory board or community benefits agreement, and an approval letter from the local government. There are opportunity zones with these already in place. in and around Baltimore. Um, With respect to the locations of the zone, specifically, I'm sure a lot of you already know where those are. This state program is coordinated through the Department of Housing and Community Development. A gentleman by the name of Frank Dixon is the administrator for this state Opportunity Zone program. So if you have any questions with respect to coordination among the departments, planning, environment, DHCD, Department of Housing, Community Development, and Commerce, you could contact Frank, and it's Frank, F-R-A-N-K, D-I-C-K-S-O-N, at DHCD, and if you Google that, you'll find his contact information. As I mentioned, the enhancements are rather insignificant, but for the biotechnology and cybersecurity investment incentive tax credit, you see that the tax credit goes from 50% or 33% of the investment up to 65%, 75%, 50%, depending on the investment. And the credit can go from normally $250,000, $500,000 for the credit, the state credit that is, refundable credit, depending on the jurisdiction, up to $750,000 investment. So again, timing and knowledge is everything if you're able to find the niche of the program for your investment. In fact, we're getting inquiries from entities, businesses, as well as technology, cyber, and biotech companies that have found these programs. And it comes from the specialists like you guys out there. This isn't someone from, that has a small office or operates a small practice unless they're very specialized. Because you have to understand general tax requirements of an opportunity zone business, an opportunity zone fund, and then the nuances of the tax credit programs. With respect to non-manufacturers, I mentioned the next slide, for businesses that would qualify, Senate Bill 581 mandates that the business not be a business that provides adult entertainment, retail, like most tax credit programs will not incentivize retail, except for state enterprise zones. If the local government agrees, then we'll incentivize retail. Retails are excluded from the program except for grocery stores. And also, and this catches a lot of businesses engaged in the sale or distribution of alcoholic beverages. You have to add only 5 positions, but the kicker is the salary requirement is $50,000. So you can fit that niche though. If you're a technology-related company, even if you don't have IP in cybersecurity or biotechnology, you can qualify because the wage level is not that difficult for high income, high revenue business. The program also provides that you have to have, like all other More Jobs for Marylanders qualified businesses, offer ongoing job training and continue that training through the 10-year life of the program. You have to provide a written notice of intent to enroll to Commerce, begin hiring within 12 months of that. And another requirement within More Jobs for Marylanders is that you not move your business from one county to another. With respect to the More Jobs for Marylanders tax credit on the next slide, this details difference between the new manufacturing business, which remember was the More Jobs for Marylanders program, historically going back an additional year. Again, the recent legislation in 2019 expanded this to non-manufacturers. The benefits are quite considerable. As I mentioned, a refundable tax credit against the highest, the credit is calculated on the high state tax rate of 5.75%. And in addition, if you're a new business, you receive a credit against the state portion of the property tax, which is 11.2 cents per hundred. Refund of sales and use tax, which can be considerable because it lasts throughout 10 years of project-related acquisitions. And finally, a waiver of the fees charged by SDAT. Those are the annual fees. Lastly, we want to mention whether or not the business will qualify for the More Jobs for Marylanders tax credit. Next slide, please. And this is dependent upon the NAICS code for the business, the North American Industrial Classification System code. Must be a 31, 32, or 33. That is determined by the facility operation. The majority of the operation has to be devoted to that NAICS manufacturing classification. It is researched and validated by the Maryland Department of Labor. That is, as you practitioners know, is connected to your workman's compensation rate, so it is checked by them. DHCD has a map available for the opportunity zones in Maryland. There's 149. Again, I mentioned that a business can't move from one county to another. Basically, again, there are some minimum job requirements in the manufacturing. That is, it must pay 120% of state minimum wage for manufacturers, $50,000 a year for non-manufacturers. Currently, the 120% calculation is for wages is $12.20 an hour. That wage is going up, which may affect manufacturers adding new jobs, particularly in rural areas, because the rural cost of living is less. The manufacturers will have some concern on keeping up with the 120% increased wage requirement. So that quickly is the focus on the Maryland tax credits on opportunity zones. A little niche, part of my world. I left my phone number here on the front, as well as my email address. If you have any questions, I'd be happy to answer them. Again, not the major part of tonight's focus, but it's good that we mention that Maryland has some incentives to offer the opportunity zone business. Yes?
Just as a matter of curiosity, in all of the effort here, has there been any effort on the part of Maryland to link up this particular program with the effort to provide businesses and jobs for veterans?
We have a particular credit that focuses on hiring veterans. It's Our Veterans Tax Credit. That program isn't addressed here, but the state does have a program that's available for small businesses hiring veterans.
So you could link the two, actually.
It's not a requirement that they be in opportunity zone.
Yeah.
But if you actually wanted to kind of push this, you would have them a double reason.
Sure. Right.
In general, what we're seeing in the marketplace is that these programs generally qualify, these projects and these businesses generally qualify for other credit programs, federal and state. For example, all of the locations in which the qualified opportunity zones are located, they're actually derived from the definition of what a low-income community for purposes of qualifying for the new markets tax credit. So it's not necessarily so easy to structure the same business to obtain both the new markets tax credit as well as the qualified opportunity zone tax benefits, but there is nothing precluding any qualified opportunity zone project to obtain any other credits under any other program. So we are seeing layers and layers and layers of different credit programs in low-income communities, which is reducing the cost of the investor's capital and enhancing returns. And so if someone's really going through that, you can have 100% increase in your potential IRR, and you can reduce the cost through some of those credit programs.
Is there a capital stack section in your book?
No. I've mentioned coordination with the other programs at a high level, but I don't go through in detail. I'm not really a credit person. I mean, we coordinate with other credit folks.
There's a few businesses that it would be difficult that are prohibited from operating in the zone. Also, a few, based on the requirements, it's difficult to actually operate certain types of business. Can you discuss that? Anyone?
Do you want to take it?
Sure. So, well, you mentioned, so Liz mentioned during her presentation how you are limited to no more than 5% of your assets being treated as non-qualified financial assets. So what that means is basically, so for example, a bank, okay, where their assets would consist of, where they'd have substantial financial assets, wouldn't actually meet the requirements of a qualified opportunity zone business. Vadim and I are going to have a call with someone who contacted me after writing the book who wants to put an insurance company inside an opportunity zone, and I'm going to let Vadim figure out how to make that one work because I'm not there yet.
Yeah, there are certain businesses that are just excluded by virtue of the rules. They're generally like sin businesses, liquor stores, country clubs, golf clubs, things like that. And then there are some things, like David mentioned, that are excluded by virtue of the rules, so the non-qualified financial property rule. One of the ones I think we've been thinking about conceptually is one of the rules for the business is that you have to use substantially all of your intangible property in the active conduct of a business in the zone. So what does that mean if you have a startup that its primary asset is intangible property as it starts growing? How do you track the use of that in the zone versus the use of that elsewhere? So
and that's where they should talk to you about how to structure their agreements. You should have, it may make sense to actually memorialize your use of those assets through IP licensing agreements, between entities.
yeah, spinning it off into a separate entity. But I think it's hard for a startup. How do you monitor? It's hard to monitor that, especially if you're, dealing with someone that's their first business. They have a lot of other things going on, trying to figure out how much of this intangible property is being used in the zone. So I think businesses that are heavily invested in intangible property obviously can be part of the program, but there's some more factors to think about there.
We talked a lot about basically that these investments should be made in cash, basically, but a lot of times that you're not actually deriving the same cash as the gain that you're deferring. Can you discuss basically whether people can or businesses can actually donate property to the business or contribute property to the business, and how does that affect the returns or the deferral?
So when you contribute property, you get the portion of the property up to your adjusted basis is a qualified investment, and any excess over your adjusted basis, the delta between your fair market value and your basis is going to be a non-qualified investment. So it's a mixed fund investment. So for example, if you contribute property that's worth $500 that has $100 of tax basis, only 20% of your investment is going to be qualified. So you have had to So first, you've had to recognize capital gain equal to that $100. You've had to invest it in, and then only 20% of your investment is qualified. So if you're not a related party as to that business, you may be better off selling the asset to the fund in exchange for cash and a note, and then just contributing just either the cash portion, and then have it depends what you can kind of look at a specific deal, but you want to be careful about having a portion of your investment be non-qualified. It's not a problem. Anyone can invest in a qualified opportunity fund, but in order to get the tax benefits of the deferral and the tax-free appreciation, you have to have only your qualifying investment there. So there has to be the reinvestment of capital gains portion. But as it relates to a contribution of property, it's only the tax basis, not the fair market value.
And I think you also have to think about what is the fund going to do with that property. So generally, we talked about ad nauseum, there's this two-tier structure where the fund isn't actually operating the business. So now the fund has this property, it's not really operating a business. You say, oh, well, it can contribute it to the business, right? But unfortunately, there's a rule where all of the fund's interest in the lower tier business have to be acquired for cash. So you get into some problems. I haven't seen a situation where that's been successful, as opposed to just the person selling the property and rolling the money into the fund.
Well, what's a good way to basically, if you do want to contribute property, what's a good way to basically transfer the property to an opportunity zone business?
You can acquire so arguably you could acquire your interest in the qualified opportunity zone business for a nominal amount of cash first and then contribute property later. But we don't exactly have rules that say that that's okay. But you could interpret them that way if you want. Then we'll write an opinion.
Just very briefly tell us the process by which the opportunity zones themselves were determined.
So for the most part, so it's 25% of all low-income census tracts in the entire country. So every governor from every state and District of Columbia got to nominate opportunity zones. And they generally did it statistically. But interestingly enough, out of the total, there are, I think, about 8,700 census tracts in the country that have been nominated. It equates to about 12% of all census tracts in the United States. So, I mean, I know that Hogan here in Maryland took this very seriously and really tried to, I mean, they made a big, they were focused on trying to put it in areas that required investment. But because they're low-income communities, if you actually look at the map nationally, what do you find? Low-income communities are generally urban and rural mostly, and they also are places where people have low income, like college campuses. So if you actually look around the country, there was a lot of pushback. Apparently, Stanford University's campus was originally in an opportunity zone in the original formulation, and they got a lot of pushback for that. But most of the states took this pretty seriously to try to find the ones that they could really impact. The challenge is do we have the infrastructure in place to impact them in the time frame? Because some of them we don't have the transit, and we don't have the water sewer, and we don't have the traffic to be able to do it, and it takes time.
Along those lines, is the Lexington Market area an opportunity?
Pretty sure because it's west. I mean, it's north of Pratt all the way up to yeah, and then all the way out to Paco, from President all the way to Paco. It should be in there. There is a gap, by the way, that like right near the University of Maryland. I have like 2 clients at buildings in.
Yeah, it's really easy if you have a property that you want to look up online. You can see if it's in a fund, and I suggest you do it because there are a lot of surprising opportunity zone funds. As David mentioned, it's based on the income of the residents. So if you have an area where there aren't a lot of people who live, and the people who do live there have low incomes, it could be an opportunity zone, even if it's not a place that you would think of as an opportunity zone. Our office building isn't an opportunity zone.
My question's for David and Elizabeth both. In your estimation, where's your kind of cutoff in terms of plan to invest, where it's just find a fund that you can invest in and just place your trust in them, or kind of going through your, at what level of investment an investor, does it make sense for them to be more hands-on as opposed to just investing in a fund which then invests in the business?
Just because of the complexity and the transaction, just the professional fees, if you're going to try to do this the right way, I mean, I'm not really setting up standalone funds with, really with under $1 million, but $500,000. I mean, it's just so much, it's just complex. So let someone else do the work for you and do your due diligence on the fund management side.
You mentioned earlier moving businesses from outside of an opportunity zone into an opportunity zone. Are you seeing any momentum or organizations that are helping small businesses within the opportunity zone take advantage of and becoming a qualified opportunity zone business so that the actual businesses are generated or organic within the zone?
So, I mean, it's hard, it is hard to move a business from a zone to a zone because you have to double your value of your property.
You know what I'm saying? If I
Outside the zone to a zone.
If I have a small business that wants to start up and they're already in the zone, are you seeing any momentum in being able to assess those startups and those entrepreneurs to be able to get the resources?
I haven't, I mean, we had a meeting 2 weeks ago with that BDC put on with basically 40 different stakeholders. There were a couple people in the room who were there who are focused on trying to bring people together. So the state's active, and BDC's active in Baltimore, has their Opportunity Zone czar. I don't know if that's the best term, but Ben Siegel, who's trying to put everyone together. It's hard for a small business because the dollars are challenging. I mean, it's just this is complex. So it's really, to a large extent, is designed for like the mid-tier and up business side. I mean, in terms of to make the cost-benefit side, is to have mid-tier, kind of mid-market and up businesses go into a zone and start creating jobs. I mean, that's really, that ultimately the intent of the program was create infrastructure in the zone, because that has to be built with jobs that are being performed in the zone, and then people come in and they work there for decades. And so we get to improve the communities and put a lot of jobs in communities, and the assumption people are in those communities, they will buy housing in the communities, and they will shop in the communities, and they will spend their money there, and we will have an impact.
Can I ask a follow-up question?
Absolutely.
Are you finding some of your qualified opportunities on businesses that are moving into the zone of actually purchasing the properties and making the substantial improvements, or leasing?
They all want to buy it.
And then along those lines, what kind of business activities are you seeing entering or engaging in this? What kind of activities that become the use of this?
It is all over the map. Everybody's in. I mean,
Yeah, especially because the opportunity zones are located in such diverse areas. We've had farming questions, like anything you could, I was surprised by that. It wasn't something I had thought of as an opportunity zone business, but there's a number of rural areas that are designated as opportunity zones. Obviously, there's lots of easy ones to think of, like somebody is a lot of them are developers developing a building, and then they're having a corollary business to operate an event space or a restaurant or something like that. So, runs the gamut.
I do get a lot of questions from people who just want to move businesses in, but then they realize that those types of businesses they want to move in aren't really saleable businesses. It's consulting companies, and I thought about moving our firm into an opportunity zone, and then realized that people don't really buy accounting firms. So it's one of these. So you just have to make sure that the incentives align with what the business is. But everyone's interested. I mean, and there happen to be. I mean, at least here in Baltimore, there's plenty. As Liz noted, I mean, Venable's in the zone, right? So you can just sublease some space from Venable, and you can go and become a qualified opportunity zone business too.
Dave, you talked about moving the business or the desire to move businesses out of zones into zones. It sounds like you also mentioned the complexity of you have an existing business, then moving it into a zone. So, I mean, how do, again, a small business, when you talk about these numbers, that's going to cost to go through this process. How do you?
What I would say is if it makes business sense and you're considering those, and you're considering to, making, moving into a zone anyway, it's a matter of trying to come up with the most simplistic kind of two-tier structure that would qualify. The good thing about those smaller businesses is they're not going to have a lot of the complications that we have to measure about people moving who are doing work all over the place or having some locations here and other locations outside of a zone. It is easier for a small business with a single location to otherwise meet the criteria. You just have to get your initial structure in place. It's not that hard, but you're going to have some legal fees. And the accounting fees, because that is rare, and the chair of tax report CPA firm aren't markedly higher. It's not that complex on the tax reporting side. I mean, I would say it would add, might add a couple $1,000s to a tax return per year. But it's not like, it's not like changing the dynamics of that in a very material way.
Since this presentation is more about qualified opportunities on businesses as opposed to real estate, most of the funds are real estate funds. Are you seeing an uptick on funds just being created to invest in this business?
I have one.
I want to say, and I think that goes back to your earlier question, the program was really, it's really a benefit for real estate, and I think everyone immediately saw the impact it could have on real estate. And to be honest, some of the beneficial regulations that we have about operating businesses, like this working capital safe harbor, we didn't even get for operating businesses until May. So I think we're going to see more movement into operating businesses. It's just like, it was so easy to apply to real estate immediately. The guidance the IRS gave us immediately was very focused on real estate, and I think as we're moving through the process, we're getting more information about operating businesses. But based on what we initially had from the IRS, it was hard to structure an operating business into the parameters of the program, and now I think there's going to be more flexibility. So I think it will definitely be something that changes over time.
Heavy asset businesses work really well. Certain types of, some of the technology companies and research companies where you can kind of really have a team of people who are doing that type of work, who are just researching and writing code and things of that could work really well. So it's trying to, you got to really understand what type of businesses work, that meet the criteria without substantial headache or the idea that you're going to go through this whole process and then you're not going to qualify.
Have you seen any successful qualified opportunities on businesses in Baltimore?
There is there's a group that is doing a very there is a group a company that's doing really well that's planning on doing a whole campus inside of the Opportunity Zone. This is a company that's looking towards an IPO. I think you would.
What kind of business is it?
It is it'll give it away, so I'd rather not say exactly. But by the way, I'm looking at throughout the country. I mean, it's not because I happen to be getting calls from around the country. I was telling someone earlier, I have a client who's in Ohio who's a pharmaceutical distribution company, and so they have a 200,000 square foot facility outside of an Opportunity Zone, and they're out of space. And they were looking for new space. When the Opportunity Zone legislation came up, they decided they're going to focus their efforts on Opportunity Zone, and they're going to do a 400,000 square foot facility inside of an Opportunity Zone. So they're moving 150 jobs into an Opportunity Zone. And they're putting in $8 million capital investment, not to mention the debt, to build out this facility. So you can imagine that, that is exactly what this program is intended to do: shift jobs, and then when we build this, we're going to have jobs, and then we're going to create the jobs on the building of that infrastructure for a business that will hopefully stay in that community for a very long time. It's a traditional distributor to Walgreens.
Actually, I guess that's kind of an interesting point. There's talk about shifting businesses from outer zones into zones. And I guess that's probably the more complex and the issues are more interesting, but in the general landscape, and this is all for David and Lee, are you seeing more, let's try to shift things, or are you seeing more, let's put something new?
Well, businesses would love to shift all of it into a zone, because then you'll have 100% qualifying investment. If you can achieve your sort of growth targets after 10 years, you would have 100% of your gain be qualified. Sometimes that's just not feasible. So we will have so we could have a zone and you could have a non-zone and a zone entity side by side who each own business assets, and you're going to have to work through the relationship between them, because from a tax incentive perspective, you want to shift as much value into the zone as possible. And that's what what are you going to put in the zone? And that's where I say you want to put in the zone the types of things that drive increased appreciation value.
Is this going to look like Kansas City only on national, where businesses go across the river, depending on what state puts up only on a national level between opportunity zones and non-opportunity zones?
I mean, we're seeing big companies that are looking at this. We're seeing big companies locating into zones. I have a project I'm working on where we have a Fortune 50 company moving a mile to build into a zone. So they're definitely looking at it. Remember, the other thing here is that sometimes they're looking at it for a couple other reasons too. There are non-tax policy reasons, but are actually on the community side, where some of these companies want to be in a zone. They want to be in an area where they're investing in low-income communities. And banks are lending to projects in qualified opportunity zones because it helps them in many cases meet their CRA requirements. So we are. So you have a lot of interest from a lot of sources of people who are trying to go into a zone to achieve not just tax goals but also public policy goals. And interestingly enough, in the family office world, where I spend a lot of my time, I've seen I have a number of side-by-side investments in opportunity zones with their foundations, even though they get no tax, even though there's no tax benefit.
I was wondering if you had any additional insights.
I forgot what the initial question was, sorry.
My initial question is, are you seeing, there's a lot of talk of businesses moving, because that's kind of like the more interesting kind of, fact pattern to pick apart. But are we seeing more businesses thinking, how are we going to relocate? Or is it more, where are we going to invest, where are we going to build something new? And my general kind of, and the bigger thought is this just doing like what happened in Kansas City, where businesses move across the river to capitalize on whatever incentive Kansas or Missouri offers at any given time?
Yeah, I haven't seen anyone successfully relocate. It's all been new.
One item I'd like to discuss is basically a lot of the purpose of having an outside investor is that investor is basically he requires some sort of a return. And the way that this is structured, how can the distributions be made throughout prior to the actual disposition of the opportunity zone business, and whether those distributions are tax free, and basically like anything, how this would be treated differently than a normal investment.
So in general, the only difference from a normal investment during the lifespan of your investment in qualified opportunity fund, you don't get basis for your investment until you recognize the gain other than the 10 and 5%. So in the case of leveraged real estate, which is where most of the fund investment is, you get debt basis. You get debt basis from the entity's borrowings. So to the extent that the entity generates cash flow, either from operating cash flow or from a refinance, you should have basis to receive your distributions tax-free or under the same general tax principles if it's operating distribution. So you're really, if there should be no economic difference excluding the deferral and excluding the deferral and the tax-free appreciation from an investor's perspective, you should have no tax difference in your investment, other than if you run into basis issues.
Yeah, I would just say normal distributions are fine. There's a long list of things that are called triggering events. So if they happen before the expiration of 2026, they can cause you to lose your deferral benefit and recognize your deferred gain earlier, but a normal tax distributions you would think of wouldn't trigger that.
You're very limited on what you can do to transfer an interest in a qualified fund after you've made the investment. You're basically limited effectively to contribute to a new partnership, that's okay, and you can transfer it to a grantor trust. So you can do a gifting transaction to a defective grantor trust. But you otherwise most other transactions, even a gift, is not acceptable. So a plain gift to your children will be a triggering event that will cause inclusion of the original deferred gain.
So does that impact as to basically someone trying to sell their investment prior to the 10 years?
So that's on that one investor. So that'll be if that investor sells prior to 10 years, he will pick up tax. If he held it past the 10 years, he would not have. So it's your 10-year holding period is determined at each investor level, not at the fund level.
What happens if you have an estate?
So the rules are fairly favorable for estate. So basically, if you hold it and then you die, the transfer to an estate is going to be fine, and the transfer from the estate to its beneficiaries is fine. So that's basically the only that they allow that. Now, the gain, the original gain that you have is that you defer. You don't get a step up and avoid that. So it's going to be treated the same way that you treat income in respect of a decedent. So you're going to have to the extent so you can defer it because it goes to the estate, but you will pick it up. So if you make the investment today, it's not the basis step up because you died holding it is not going to eliminate your original gain. I would say on the estate and gift side, what's interesting is if you do use grantor trust as part of your qualified opportunity fund planning, you can actually get a basis step up inside of a grantor trust tax-free, which you normally can't do if you had it in a tax-free and then you died. You wouldn't here because the gain appreciation, you get the gain, you get the cash and it's taxed, and you have no gain. It has the effect of being a tax-free basis step up inside of a grantor trust, even if it's outside of your estate.
Any more questions?
So I'm curious, I'm having a little trouble visualizing how something like a cybersecurity company might take advantage of the opportunity zone. And like another kind of tech company, they have a lot of equipment that they're bringing into an area, but something like a cybersecurity company, they might have an office, but what does that look like exactly? Have you seen any?
Yeah, so it's just not a big. So let's just say a cybersecurity company leases space in a building in here on Pratt Street, and all they do is just fill, and then they go and they acquire some desks and some copiers, and that's basically it. That's fine. That's your investment. That's the amount of capital gains you defer, and then you build a company and you build a company to be worth $100 million. It doesn't matter if you invested $1 on day one or you invested $10 million, all of that appreciation will be tax-free. But you're not going to get much on the deferral side because there's just not a large capital investment.
So with respect to cyber companies, you have different types of cyber companies. You can have a cyber company whose value is the IP that's specific to contracts. The value is created to the owners by the life of those contracts. You can create a cyber company basically with a few laptops some employees with a federal security clearance, and then IP. So if you develop that IP and it's applicable or marketable to national or international banking, airline, energy, that increases the value exponentially quite rapidly. But as far as a cybersecurity company, you can have a company that exists basically in your mom and dad's basement, and you can have a cybersecurity company that employs 50, 100, 150 people that major national and international companies are focused on. With respect to the state, we target startups, so the incentives there are quite substantial. So wanted to throw that out. Bio is long-term to get FDA approval, major investment, major cash burn for 10, 20 years or more. So you have to understand your industry, and it's particular to the IP and where you are. Thank you.
Okay, I would like to thank the panel, and Fred Brown is going to